Hey everybody, welcome to our YouTube channel. My name is Glenn Tompkins, and everybody knows the big news that Amazon split. 20 for 1. That's a big split. Now, is that a good thing or a bad thing? Whether you own it or not, I'm going to argue the case why the split was a good thing. If you want to find out what I've got to give to you, you sit right there. Hey everybody, Glenn Tompkins here on our YouTube channel. Thank you for being here. Love it that you're here. So the split happened. The stock split will effectively, and I've got some excerpts from the internet, the stock split will effectively divide Amazon's current shares into 20 smaller pieces of the company. And that's a good thing because it was trading so expensively. Using today's price of $2,135 after the split, Amazon would trade for about $107 per share. That's a big difference. And the beautiful thing about that is a lot of people have liked the Amazon stock for a while, but said, man, it's just too expensive to buy. Now, it's not nearly as expensive, and it brings new blood to the game. It gives more people the opportunity to afford a stock that overall has been doing well until recently. While it doesn't directly enhance the company's market capitalization, it makes Amazon shares far more affordable to investors. And that's the big reason why you do something like that, so that people who weren't able to take advantage of that company at that high price can do so now. Now, this was Amazon's first stock split since 1999. Wall Street Journal, the e-commerce giant's 20 for 1 stock split went into effect on Monday. The split will, in part, make the tech company's shares more accessible, the company has said, and the 20 for 1 split was approved by the Amazon's board earlier. Now, that said, Amazon split still leaves it open on inclusion in the Dow Jones Industrial Average. Number one reason why this is a good deal. See, the 30 stocks that are found in the Dow 30 are some of the most prestigious stocks in the trading sphere. And if Amazon can get on there, that would bring so many more eyes, more attention, more big money can get into that stock, because there's a lot of big money out there that have the constraints on what they can buy. Maybe they can only buy from the Dow or the S&P 500 and, those kinds of things. But putting them in the class of Dow stocks is going to be super for them. And at the price that they were, it was hard for them, I think, to be on the Dow trading at $2,000. In a minute, you're going to look at the stocks that are on the Dow. None of them are trading nearly that high. So, and I think that was in not keeping those stocks into the Dow, because big moves for that stock could affect the Dow adversely. So keeping that in mind. All right, now we're going to move from here and we're going to go right into the VectorVest software. And I want to bring up the Dow 30 stocks. Look at the stocks that are on the Dow: Chevron, United Health, Merck, Travelers, Visa, Home Depot, Nike, Dow, Apple, Caterpillar. So, and these are companies that everybody knows, and these are companies that people feel more comfortable in being in for the long term because they are so well known. Now, if Amazon is to get on this list, one of the companies that are here would have to go away, and I don't know which one it would be, and I don't know how long it will take before it can be included in the Dow, but they are setting themselves up for that kind of situation to be incorporated in the Dow. And notice, look at the prices. Some of these are more expensive than others, but none of them are trading at that price of over $2,000. So there's certain things that need to be met for a stock to be included in the Dow. And now Amazon sets themselves up to actually at some point in time to be included in the Dow 30 stocks. So that's my number one reason right now why this was a good deal. All right, now let's go back, and I'm going to take a look at some stories that I have on here as well. This is from Investopedia. Amazon's big split. Amazon's 20 for 1 split took effect today. That was Monday at the price of $120. How about some other stocks that are looking to do the same thing? Google, Tesla said that they want to do it. They haven't announced what the ratio will be or when it will be. Google announced a 20-for-1 stock split set to take effect in July. Companies that trade so high, that are good stocks that people want to be in, this is a good way to get more fresh blood into those stocks. All right, so from here, let's go to the next story that I have. Amazon stock split for the first time in 23 years. What it means, and this comes from another Deseret News, another spot. I never heard of this space, but what it means, according to Amazon, according to USA Today, Amazon shareholders got 19 additional shares for everyone that they owned before Monday. And now that was great for the people who owned them, and now you got more shares. But for the people who had no shares, now you get a lower price. Is this a good thing? Answer: yes. Why? USA reports stock splits are a good sign because they mean that a company has done so well over time that the price of a single share is too expensive for an average retail investor. Number two reason why I think that this is a good thing. They've seen it over and over. They've grown their business from where they were at IPO to where they are now. They've done well, and now they said, well, all right, let's take this down. Now, another thing about this is, what else can a company do? A company can also offer dividends. I'm going to tell you why they don't offer dividends at this particular point in time. All right. Now, something else in here. Bank of America reported that a stock splits potentially result in higher prices. Where did it just go? Yeah, and higher returns, saying that S&P 500 companies that announced stock splits since 1980 have returned on average 25.4% over the following 12 months versus the S&P average, which is only 9%. 9, 18, 20, almost 3 times more of a return after a split. That is number 3, why this is a good thing. Chances are that Amazon will return 3 times more than the average stock in the S&P 500 over the next 12 months. All right, my last story I've got here. Amazon stock split delivers more than bargained for. Shares have tumbled since the company announced 20-for-1 split. The decline means prices will be even lower than anticipated. That's reason number 4 why I think Amazon is a good thing. Why? Because to alphabet including where is it? Here we go. The sell-off means, and I don't call it a sell-off, it's a pullback. The sell-off means that the stocks will be trading at a discount to the sticker price originally envisioned by executives. That will make it easier for the behemoths, the big people, the big companies, to gain entry into the Dow Jones Industrial Average, whose weighting is based on share price. And then again, we've now moved from $2,000 to now $100, $100 and so dollars. But it could have the effect of making them look less princely than their massive market values and history of big gains. I do like the idea that the S&P gave the statistic that stocks that split tend to go up about 25% more than the average, or 3 times more than the average stock in the S&P 500 over the next 12 months after the split. All right, now let's get back into the software. And from here, where's my graphs? Here, we're going to start looking at the Amazon graph. And I've got a 5-year graph on Amazon. Amazon was kicking butt, taking names. And you know something? Could they return back to this same graphing layout? And my answer is yes. Not only was the stock's price going up, look at the earnings per share. We always say that earnings is the engine that drives the stock's price higher. So not only was the stock price going up, but look at the rising earnings. Most recently, after COVID, after we've gone through this battle with inflation and the whole idea of trying to get goods because of the supply issues, Amazon has been hit. But I wanted to see what's the probability of the company looking like it was back here. So I wanted to see what Amazon was worth. Right now, as of June 2nd of 2021, I couldn't get all the way to 2022. I need to do more research. $314.9 billion was their worth, and they have a debt of $7.7 billion. Now, put that on the scale of other companies in the same kind of space that Amazon is in. Twitter only has $1.7 billion in debt. But there's some stuff going on at Twitter right now, along with the deal with Elon Musk. Google, $3.9 billion. eBay, another online practitioner at $8.9 billion, a little bit more than Amazon. And Alibaba, another online company, $13.3 billion. So put all of that together, I think that Amazon has the ability to go back to times in the past when they were rocking and rolling at a lower price, and big money has an opportunity to pick them up as well. So let's take a look at the other one. So I see the dip in Amazon. Here's the split. The company makes money. They have an earnings per share of $1.49, and they have an earnings growth of 18%. So they grow their earnings at a double-digit clip. This is happening because of what's going on in the economy right now. Let's go look at Twitter. Twitter, a little wiki wonky with the earnings, but still higher than it was 3 months ago. Earnings per share only at 83 cents with a growth of 22%. And Google is looking hot, still running with the most recent economic issues going on, falling below the 20-day exponential moving average, but they are making money and growing it at a clip of 28%. But look at the price. This is what Amazon's price looked like before this split. And Google, because of its high price, is also looking to do a split sometime in July. Keep your eyes open for that. But I do like Google's equity curve. And let's go down to eBay. eBay, man, falling hard. Earnings just starting to fall off right now. They are growing their earnings at a clip of 17% a year. And the last one is Alibaba. Oh, man, they really are getting smoked. Earnings are getting beat, but they are still up. No earnings growth at all. So if I'm still looking at this, and let's go back to what I was going to talk about with dividends. Why is Amazon not pay a dividend? Because that's another way to make it more attractive for people to buy. And the short answer is that Amazon does not pay a dividend because the focus of Amazon is growth and expansion. A dividend payment would take away the funds needed to expand. They have stated several times, and even on recent earnings calls, that there is not a plan for Amazon to pay dividends. Well, I'm thinking that at some point in time, if the bottom line doesn't look better, all right, if the bottom line doesn't look better, they may have to put dividends on the table as something to discuss. Again, that's just my opinion. All right, with all of that, folks, I think that Amazon's got a great opportunity to look like it did yesteryear. I think that after we get through some of this inflation stuff and we get through all the supply stuff, you know, just in general, I still haven't had a problem getting anything from Amazon for the most part. My wife orders everything from Amazon like almost every single day. But I think that Amazon has the ability to, and they did what they needed to do as a company to continue to grow. They got to a point where price was so high, they were doing so well. Now the price is falling. It's going to give a lot of other people an opportunity to get in on this company. So with that, folks, this video is over. And until the next time, see ya.